it's not the GP's job to manage the LP's liquidity.
Right.
It's the LP's job to manage the liquidity. Natural evolution of funds is they're successful, they grow. They're more successful, they grow more. And to the point in many situations where the strategy has to change, we believe in partnering with managers who understand their market, who literally live their market, and are going to be able to understand, well, you don't want to do something because there's a regulatory aspect to this that is subtle. Or I'll stick with the public markets example. You better make sure that if you're going to IPO a company, it better be profitable.
Right.
Or it will fail miserably.
So, Kevin, I would love to understand your personal journey.
Mm-hmm.
How were your formative years and how did you end up being a capital allocator?
No, my journey actually starts in public accounting. And I was an auditor for a regional firm. And I focused a lot on nonprofit organizations and towns, municipalities, which was really interesting. And on top of that, I had investment clients. And so combining those two things just happened to be where I ended up.
And what was your private practice? Like you had?
No, so I worked for a firm, right? So I started straight out of school, started in public accounting, got my CPA licensing, and really was looking at things that were close to my heart. I was really happy to get into the nonprofit aspect. I've always felt a deep affinity towards education, which goes back to my family and how much my mother was someone who got a master's degree in nursing back in the 50s. Not too many women did this. So we always had a very strong pull towards education. And so consequently, I've got a brother who's a professor and my other two siblings were, extremely accomplished individuals themselves and came to the educational area. And so that's always been a big driver, big affinity. And then pulling that together with the clients, the investment clients, who one of them happened to be George Weiss Associates, and a hedge fund manager, and I ended up going to work for them. Learned a lot about markets, learned a lot about what can go wrong, what can go right, how to think about risk. Again, from that hedge fund context. And utilizing that, the other aspect that came into play there, which was very formative, was George Weiss had started his own nonprofit, which was called Sayest Education, and essentially was providing tuition to inner city kids to go to college for free. And these are kids who have nothing.
Right.
So, and the reason for that is because he grew up very poor. And so he was giving back. And so that all just germinated and spoke to me. I had the opportunity to go back to my alma mater, University of Connecticut, and work for their foundation and kind of pull all this together. So I went there. Now, mind you, I'm still in the back office. I'm still doing the accounting. I'm still doing reporting. And so going to UConn, and I was reporting to the investment committee. This was a startup. The university had been around for over 100 years. The foundation, this was a startup. They had not been in the fundraising mode. They had a very small endowment. Because of its location, we had a lot of Wall Streeters involved in our investment committee. And sitting in on those meetings and providing them data and understanding what it was they were looking for and listening to their conversations, it became very apparent what they were doing and thinking about was much more interesting to me than what I was doing. and plus, you think about the logical conclusion. Okay, if we're successful fundraising, if we grow this endowment, well, you've got a group of volunteers who are basically making all the decisions. That doesn't work. That doesn't work once for any long period of time. And so at some point, they're going to need somebody on the inside.
Right.
And so I want to be that somebody.
Right.
And so I got my CFA and gradually transitioned, jumped over the fence, and had the ability to not only help manage the endowment, but and put in processes and rethink asset allocation and work with a number of really smart people, but also to build a team, a very small team, because again, it was not a big endowment. But we started to be able to actually build and grow. And so that was very exciting, which I discovered, I like building programs. I like building teams. I like mentoring people. This is, so all of this, came to fruition. And so I'd say those were the formative aspects.
Right. And from UConn, you went to Hartford Medical?
Yes, went to Hartford Healthcare.
Right.
And so best interview I've ever had. I'd known the CIO, the then CIO, for over a decade. Hartford, much like where I am now in Pittsburgh, very tight-knit investment community. And so we had monthly dinner meetings with the various constituents of the investment community. And so we got to know each other's style and whatnot. And so he called me out of the blue, which he never did. And basically the question was, what would it take to get you to leave? Sorry.
Wow. Pretty straightforward.
That's very straightforward, which was not unusual for him. But also just, I was like, wow, it's not something. So anyway, obviously he was able to meet the mark. And so I left. And the exciting thing there was I was wearing two hats at UConn at that point, because I was not just the CIO, I was the CFO. And so I was being pulled in a lot of directions. And I saw this as an opportunity not just to build programs and whatnot, but to really focus all of my time on investing again.
Right.
And so I took him up on it. And we built a team.
Right.
And now he had already started, he had some programs built out. He had some programs he was starting to build. There were others that we had not started to build yet. So really trying to build a strong and cohesive portfolio for multiple portfolios, I should say. Endowment, also a defined benefit pension, which was frozen at the time. And then a small offshore captive insurance portfolio as well, which a lot of healthcare systems have. So yeah, that gave me a lot of learnings. Also just, again, got me more immersed into the investment side from that time forward.
And I did my research. So through this time, I believe you outperformed everybody else during the great financial crisis. Can you talk to us about what that experience was like?
So this is, boy, I wish I could say it was great, but it was the great financial crisis. No, it wasn't so great. But this was at UConn, at the foundation. And yes, so we did have a loss, but it was substantially less than what the broad market was doing. And so
I see it was -3% versus minus a lot for the rest of.
Yeah, double digits somewhere. And so really the reason that was able to occur was our philosophy at that time was, we're really small. We're trying to build a program. We're trying to prove ourselves, not just to the university, but to donors. And so we wanted to be as efficient as possible. Yes, we need to attain a certain return, much as we do now. But we want to make sure that we're doing so in as low a risk way as possible. So build basically is a robust portfolio as we can possibly build. And so that meant we introduced some hedge funds that provided some great downside protection during the GFC. We were invested in some totally uncorrelated areas like drug royalties, where, quite honestly, people need to take their medicine.
Right.
So, you're not going to stop unless, it's just beyond your control. So by having these types of investments, being very mindful about the type of risk we were taking, and I would term it, well, we termed it then risk aware.
Right.
So we weren't risk averse, but we were very risk aware. And that's what we felt we needed to be. So if you think about it in another way, we cut off the tails without doing an option strategy. So the left tail, that worked to our benefit during the GFC. But it also meant if markets really ripped, we'd do well, but we were not going to participate the way that others might.
Right.
So, but that's, again, it tuned into the philosophy of the organization at that time.
No wonder Hartford wanted you in and made a very direct pitch to you.
Yeah, he might have been desperate too. I don't know. But no, it worked out incredibly well. I was there for 8 years. Like I said, we built a lot of great programs. We built a really strong team, and that actually, that portfolio over that time, we were top decile for a lot of years. And again, risk aware, because think of what a health system does, has very low margins, and they issue debt into the public market. So the credit rating agencies are very focused on, well, what the makeup of the balance sheet. The investments were a very sizable part of the balance sheet, especially you pull away the plant, of the hospital facilities. It was the next biggest thing on the balance sheet. So they were really focused on that. So we had to be very mindful about risk from that perspective as well.
Right. And how did you go from Hartford to Pittsburgh to CMU?
I drove in my pickup truck, and no, it was situation where Hartford Healthcare, for its own reasons, decided we're going to outsource the investment function. I think they were, on one side, roughly half of the portfolio was a defined benefit pension. And it was at a point where it moved to an overfunded status, and the thinking was that they would annuitize it. So then started calling around and thinking about, well, what do I want to do next? And still feeling that, well, what have I done well? What have I spent a lot of time doing? Building programs, thinking about strategy, thinking about asset allocation, thinking about team, mentoring people. So where does this take you? Early on in that, I had a great discussion with a member from Korn Ferry, Michael Kennedy. And he said, I've got something, after we'd spoken for probably about an hour. Said, I think I got something I want you to check out. And so he said, there's this position at Carnegie Mellon University, and under Chuck Kennedy. I said, well, I know Chuck Kennedy. I've met Chuck Kennedy's before. And so had a good deal of respect for Chuck. And so Michael put us in touch. And I don't know how many conversations we had. It was a number. It seemed like it was every few days we were on the phone. And so eventually, obviously, went through the interview process, met the team, saw Pittsburgh for the first time in my life.
Oh, really?
Yeah. I had never been before. And saw what they were looking for and what my skill set was and what I was looking to provide was a good match. And so they obviously agreed. And so there off I went.
Great. So you joined Carnegie Mellon University. It seems like a no-brainer. It's a fantastic institution. So you're 3 years in. Mm-hmm. How has your experience been like?
Sure. So I mentioned UConn was, of course, really small investment portfolio, both endowment and non-endowed. And so endowment, when I left, was a bit over $300 million. And we had another couple $100 million of non-endowed assets that we managed internally. Go to Hartford Healthcare, and I'm helping to manage $4 billion. So $2 billion endowment, $2 billion pension, and $200 million or so of insurance. and coming to Carnegie Mellon, and right now we're just over 4 billion. So similar size pools, just different purposes, right? Carnegie Mellon has a very global footprint in its portfolio, again, primarily through the private markets. And we're going where there is growth opportunity and where that growth is investable and structurally sound. And so you're not only seeing opportunities to make money, you know that because of this, how sound this is, you're going to get your money back. You're going to be able to get your money out. And so early on, we've been in Asia. We've been looking around. I'm hearing more and more about India. I want you to go check it out. I want you to go figure out, is this real? And, India has had a history, unfortunately, over its history of giving some pretty big head fakes. So the demographic story has always been there. But do we have the policy? Do we have the market depth? Do we have, all the other things that you really want to make sure that are in an area where you're going to put money to work, especially as a fiduciary? So did my desk review and made a lot of reference calls, got a lot of great references from managers and other investors, and especially in the Pittsburgh area. Lee, who I know you've spoken with from Dietrich, is all things India. He's the knowledge guy. So he was probably my first phone call.
So take us back to your first visit to India. How was that experience? Was it what you expected, or was it something different?
I think in large part it was what I expected. I mean, okay, I know there's a lot of people. Fine. I'm going to Mumbai. I'm going to Bangalore. There's a lot of people. There's a lot of traffic. That was the first thing I think people said to me. There's a lot of traffic. However long you think it's going to take you, at least double it. And it's like, okay, well, I can do that. I can manage my calendar that way. But what I found, I think, was in my brain, at least in my view, is perhaps the most truly capitalistic environment I've ever seen. And you juxtapose that to the early days of India's experience, where it was very much a socialist society and economy, and how that has flipped significantly. And so you think about things you discover, is one of them, and one of the most significant ones, is that there's a reason why there's a lot of entrepreneurial activity in India. And a big chunk of that has to do with not having a fear of failure. Because you just have to do things. You have to make something work to provide for your family, to really drive your own opportunities. And so it's okay to fail. It became clear early on. It's very acceptable that if this doesn't work out, it's okay. I'll try again. And it's not a problem. It's nothing I did wrong necessarily. It's not a black mark. And so just from those simple things where people are pulling together flowers on the side of the road to, their kiosks and small shops, and it just was really an astounding sight. The other thing that really impressed me, and impresses me more every time I come, is the infrastructure build. So yes, of course you read up and say, okay, the government's putting a lot of money to work on infrastructure, but then you see what that actually means in action, and the roadways that are being built, and coming in this time where the train is going to go, that's going to take you from downtown to the airport.
Right.
And subways that are being built, and just that infrastructure is amazing. And actually, this goes back to the first time I was in India. I was going to be there over the weekend, and I had hooked up with a manager I knew who was a global EM energy manager. And so they had several projects in India. So I'd call them up and say, hey, I'd like to go see one of the projects. And so we leave from Bangalore. It took 5 hours to get to the location, which I thought it was 4, but as with all things, it takes longer. But what was clear is you get to the edge of Bangalore and you're still seeing construction. And you get into the tier 2, tier 3 cities beyond Bangalore, and you see all this construction supplies and piping and things that are ready to go in place to actually make a roadway. And you realize this isn't just an urban thing. This is this country trying to connect itself together, and what that can mean to the people of India. And from my perspective, from an investment thesis, it's just has been absolutely astounding. And so, like I said, every time something new. A driver I was with in Mumbai earlier this week said, yeah, there's over 400 projects going on right now. Right. That's why this is crazy.
And how do you distill that observations that you've made, right? And amongst the many trips you have come to India, how do you distill that into an investment view? And you're a global investor, so you have an option of doing any geography you like, as well as any asset class you like. So how does that go back into your investment committee setting for you to think about where this can potentially fit into your portfolio?
Yeah. So again, it starts with the demographic story. It starts with the growth story. But that's only the beginning. Then looking at the fiscal policy and the rule of law that's put into place. So there have been some very significant changes over the last, at this point, probably 12 to 15 years. The new bankruptcy law, the whole digitization aspect and Aadhaar and everything that goes with it, UPI and the rest. That transformative impact led us to believe that, yes, this is real. This is structurally sound. These policies are in place, and they were started under the prior party's rule, and then under the current administration just continued and ramped up, if anything. So the odds of anything being reversed if there's a change in power, it's not going to happen. So you've got stability. Right. The other aspect is, hey, this government's been in place for a long time, which is very unusual for us. So obviously there must be a feeling that, hey, things are going in the right direction here. Otherwise, yeah, we could make a change, but we're not going to. So you have that kind of stability. You have the policies and fiscal law that's put in place. You've got that surety of protection through a bankruptcy law or laws. And so it becomes very clear this is investable. So then it becomes, well, okay, what do you invest in? So energy would be a possibility, very CapEx heavy. There's all kinds of regulatory issues there. But the fact that India is home to 25% of the world's engineers, and when you think about Carnegie Mellon University and a number of other places in the United States, Silicon Valley, the significant number of Indians at those locations being very impactful in technology of various types. And now you see them going back home to India and starting their own businesses. It's like, okay, this is starting a really big ecosystem here. This is going to be, you're going to have a great flywheel effect here. And it's happening. So then, okay, so you've got entrepreneurs. So you potentially have someone to invest in, some business to invest in. We invest through funds.
Right.
So now it's okay, well, what's the GP community look like? Is it just an early stage venture opportunity? Is it just a mature company opportunity? Is it a public markets opportunity? Where do you go? And one thing I realized early on is that this is such a growth story, and that when you think about, you keep hearing this, anytime a new company comes or a new business gets developed in a sector, and you say, well, the sector's only got 10% penetration. Well, okay, well, if you've got 90% of the market yet to go in all these sectors, then the pie that's like this is just going to continue to expand, which means the opportunity is pretty broad.
Right.
So early on, I think we came to the conclusion that yes, there's an opportunity in early stage venture. There's an opportunity in mid stage or venture growth. There is an opportunity in late stage. Yes, there's an opportunity in public markets, but I would argue there it's been much more volatile until of late. So it used to be you could gauge the Indian public equity market based on foreign flows,
Right.
and that's changed now. So even that has matured. So I'm having conversations with public equity managers, and it's twofold. One is because we are very private markets focused, generally speaking, as an institution. We are wanting to understand the exit market. Well, the exit market in India is by and large through IPO. It's going to be a public equity market. And so having that understanding through discussions with the public equity managers, that's one reason to talk with them. The other reason is it's a legitimate opportunity in and of itself. So we haven't gotten there yet, but we continue to look. So we've made some commitments through funds. We've discovered that the VCs, yes, it's still a growing, evolving, and maturing sector, but there's a lot of talent at the VC side and the GP side, and not just the entrepreneur side.
And for a global investor who's now looking at India in the recent past, what would your advice be for the global investors who are still thinking about India and still wanting to do a little bit more groundwork? What would be your advice? You
got to come. And we are big believers in boots on the ground.
Right.
And you have to travel. You're not going to see the things I described that I've witnessed and that I see every time I come. You're not going to get that sitting behind a desk or on a Zoom call or through reading a research paper. You'll get the data points, but that won't lead you to the same conclusions that you might come to otherwise. And it certainly won't give you the introduction to the managers that you ultimately will probably want to do business with. Global managers have a presence here, and there's some really great ones here, no question about it. But we believe in partnering with managers who understand their market, who literally live their market, and are going to be able to understand, well, you don't want to do something because there's a regulatory aspect to this that is subtle. Or I'll stick with the public markets example. You better make sure that if you're going to IPO a company, it better be profitable.
Right.
Or it will fail miserably here. That's not true in virtually any other market.
Right.
So you need to understand those things. And you're not going to get that unless you're here.
Right. Right. And if you can flip the coin, what would your advice be to GPs out of India, as there are a lot of homegrown funds now that are looking to raise capital from all over the world? So when you look at Indian GPs and our awareness of the global context, what would be your advice?
So I think one thing that Indian GPs do very well is promote India. Say, here's the opportunity. Here's what's happening. Here's why it's real. What I hopefully tell all GPs that I want to spend time with is, don't feel like you have to be the solution to my issues. Sometimes it's just not a fit, right? And it could be the strategy, could be the way you structure things, could be an alignment issue. But you present your strategy. You obviously believe in your strategy. Present your strategy, why you think it's a really strong and effective one, how you implement it, why you should have a great result, and let the LP do their work. and go from there. So that's one aspect. The other thing I would think about, so one thing that it's true, India is an expensive market. Broad brush statement. That's obviously not true all the time, but relative to other markets, it's an expensive market. So you've really got to make sure that we have an understanding as LPs as to why and what the opportunity set is, and how, again, we can achieve those returns that we require as someone coming in from the outside who has the opportunity to just invest in your backyard, but I'm making the trip to India to invest. So give me the reason, give me the reason to do that. But also think about your strategy and be true to it. So it's true. This is not an India thing. This is everywhere. Natural evolution of funds is they're successful, they grow. They're more successful, they grow more. And to the point in many situations where the strategy has to change because the asset base has grown too big. And so they can't make the type of investments they used to make. So be mindful. Be mindful of what type of result you can actually drive. Can I have a power law outcome if I'm an early stage venture manager at this fund level that I'm driving, that I'm building? And so I think it's just being honest with what the market is that you're tapping, the opportunity set, and then that you are structured correctly so that, hey, I can legitimately have a fund returner through one deal. Okay, well, that means something. That means I'm getting in at a certain valuation. It means I'm getting a certain ownership. It means I can hang on to that ownership, or at least not get significantly diluted, and that I can have that outcome, that power law outcome, that will produce a fund returner.
Right.
So I think it gets back to discipline. The Indian market, and I think this was starting to change when I first came here. The Indian market and GPs were notorious for no distributions. It's like, yep, you can invest, you'll look great, but you want your money back? No, just leave it here. It's good, all good. That was starting to change when I came. Some of my early conversations, the GP actually made a point of saying, "Well, this is our exit strategy,
right?
And here's the proof. Our last fund, or if this is a fund one, my prior shop, this is how we did this, and this is how we would expect to manage liquidity going forward and still achieve a really strong result for the LPs."
Right. So just going a little deeper on the liquidity topic, right? How do you think GP should think about it? Because different LPs have different liquidity requirements or horizons. And how do you manage that dynamic between the LP's liquidity requirements and the GP's view on what is the optimal liquidity strategy for the portfolio? Would love to get your perspective.
Of course you would, because I've got a strong opinion. So it's not the GP's job to manage the LP's liquidity.
Right.
It's the LP's job to manage the liquidity.
Right.
The GP's job is to manage their portfolio and do what's right for the portfolio and for the underlying companies. If they do that, they're going to be great. They're going to be fine. If an LP has a liquidity crisis or some kind of an issue that they've got to deal with, there are avenues without forcing a GP's hand or asking them to do something that maybe not be optimal for that portfolio. There's becoming a much more robust secondary market, at least in the US and Europe. And so there are opportunities there. The GP, I think the only thing I would ask a GP to be mindful of is that, okay, if an LP signals to you, I've got a problem, part of my solution is to sell part of my interest in your fund. Yes, you want to understand why the LP wants to do that, because you don't want it to be something that looks bad, reputationally on you, but help them do it.
Right.
Be that partner. So that's one thing that we believe in very strongly is partnership. So GP, in that situation, you have the opportunity to be a really good partner to us.
Right.
And so help us do it. And then obviously, hopefully we help you along the way as well. But yeah, so liquidity is top of mind always. And I think I mentioned at the outset, the strength of our operations team. They focus an awful lot on liquidity for us. And so we're having constant reviews of our liquidity ratios, our self-funding ratio, so that we don't get too far out over our skis and overcommit and wind up in what can be a really difficult situation.
Right. And Kevin, when you look at the commonly held beliefs in the investment community, are there any notions that you would challenge?
So liquidity, define liquidity risk. It seems like every time we have a crisis, we end up with a new definition of liquidity risk. Right. And so I don't know if it's as a community, we don't give it enough thought. And again, very broad brush. I just described how we've got a group that, that we look at this and we're laser focused on it. And I'm dead sure there are a lot of other LPs who are doing exactly the same thing. But for some reason, we seem as an LP community to end up in a situation during crisis where there ends up being a liquidity issue. And so,
and it gets transmitted to the GPs in many cases.
It can. I mean, again, there's alternatives for people to use, but thinking that through, are we not defining liquidity appropriately? Are we not thinking enough about the actual risk that we're running and the way we're structuring our portfolio? I mean, certainly things happen that are out of your control, right? Yeah. You can argue that the recent endowment tax in the United States. Well, okay, if all of a sudden you go from a 1.4% tax rate and all of a sudden you get an 8% tax rate, it's going to hurt. I mean, I don't know if it changes the way you are going to view your portfolio, but it's certainly in the short term, it's like, wait a minute, I might have a liquidity squeeze to fund that. It's unrealized, but still, I might have a liquidity issue that's new that I never had to contemplate before because this just didn't exist. So that's going to happen. But just broadly speaking, if you've got if markets are functioning the way they're supposed to function and typically do function, hopefully we're doing the right thing and thinking that through. So I think that's one area where LPs should probably spend more time, and just to make sure, because going through a liquidity crisis, it is not fun, so you'll avoid it if you can, right? But I think that's one area. I think alignment is an area that perhaps we don't give as much attention to as we should.
But that you mean alignment with the GP?
Yeah. And is the GP incentivized in a way that we feel very comfortable with and we think benefits us over time? That could be another area where we don't quite get it right that often, or we're willing to overlook certain things.
So in what way? Like, what are the misalignments that you have seen?
Yeah, I was just going to say, I think one thing that we look at a fair amount is the ownership and share of carried interest amongst team members. So is all the carry sitting in a very tight grouping, and you see a bunch of other team members doing a lot of work, but they're not eligible or they're just not getting very much? Basically, and the reason I bring this up is that can add to instability of that team. So think about it. I've underwritten an opportunity. I've underwritten this team. But the team has an inherent instability built into it that might pull that team apart or take a key member away from it. And now my underwriting thesis is damaged.
And you're ready for 10 to 12 years.
Exactly. At least. At least. And so, yeah, so I think alignment and that ownership aspect is key. And I see it a lot more in situations where you have interesting and unique structure that's really working independently of a much larger organization. That's the mothership, if you will. And you see a lot of the economics going to the mothership and not staying with the team. Of course, the line is, well, we get X, Y, and Z services from the mothership, which I'm sure is all true. But is it really worth 40% of the carry when you're trying to keep a team in place and whatnot? So obviously a decision was made at some point, yes. But I look at that and I say, that's a chance for people to walk.
Right.
Because, what am I giving up if I leave? Right. So I think it's those things we don't necessarily spend as much time as we should.
Got it. And what about geopolitics? That's a topic everybody's top of mind, at least this year. So how do you think about geopolitical risk and how do you mitigate that?
That's a great question. So geopolitical risk, first of all, used to be something you didn't really have to think about very much. I could really focus on, well, what's my investment thesis and how strong is this management team? But geopolitics has definitely become more centered on what we have to think about on a regular basis. It's almost impossible to underwrite. I mean, you're basically looking at either something that I have no idea what could happen or a very binary outcome. And is it something that first of all, there's nothing I can do anything about it. There's nothing the manager can do anything about. Will it ultimately impact the investment opportunity? I think that's one question. And if it's significant enough of a risk. So, if we think it's imminent that Russia is going to invade Ukraine, then I'm not going to invest in Ukrainian agriculture, or I'm not going to do something that I think is at risk based on that event if I think that's a high probability event. But if it's something that's lingering, or I think could be short term, then again, I'm taking a long-term view. I guess I'm not that concerned about a short-term impact, but I'm being put in a situation where I've got to try and make a determination.
Right.
Do I think this is potentially long-term? And do I size my investment differently as a result? Which is one option. So you asked about how do you risk protect? That would be one way to do so. Of course, the ultimate way is you just don't do the investment. But I think making sure you're comfortable in right sizing your investment, being aware, and realizing that at the end of the day, I'm trying to invest over a long period of time based on fundamental market dynamics that really have no reason to change. To boil it down is just to say the fundamentals of the investment thesis will not change or be severely impacted by whatever geopolitical risk you're worried about. I can't underwrite the impact, so I'm not going to. I can move forward, but I think that's the assessment. Is something going to fundamentally change if this geopolitical risk comes to fruition?
And what role does diversification globally play in mitigating the risks of any geopolitical uncertainties?
It's huge.
Wouldn't there be a home bias naturally getting reinforced when there's geopolitical issues? So how do you kind of weigh between the home bias versus actually having the diversification, which can make the portfolio more resilient? How do you kind of think about that?
Yeah, no, you're right on point. And when you think about home bias, one of the things we do with certainly with the investments I brought forward related to India, has been to look at, well, not only how does India map, how does this manager map against other Indian managers or emerging market managers? How do they map against US managers? Because I got to come halfway around the world to be here, right? It's not just to be on your podcast. But where if I could get the same results by investing in my backyard, why wouldn't I? But you're right. There's a diversification aspect. I was saying earlier on, we want to have diversified return streams that will ultimately drive a much more stable result that will benefit the university. And so, yes, being geographically diversified is all part of that. So we're looking, obviously, we're in India. We have been in Southeast Asia, continue to be. We continue to poke around other areas. We've been active in Latin America of late. And it's for these very reasons. You've got this opportunity set. And then, yes, it's a diversified opportunity set. So best-in-class manager, real opportunity, structurally sound, and diversifying.
And to your earlier point, the correlation also is reducing, especially if you look at the Indian capital markets. Right? They have not actually reflected what's happening in the US because the domestic investors are supporting the public markets.
Yeah.
Would that be something that you would distill out into one of the reasons why you would diversify?
Absolutely. And so, case in point, unfortunately, this year, I'm going to pick on India. Public markets in India have been sideways down, not being great, versus other markets in the world. But a couple of years ago, India public markets were doing great.
Right.
And where, other parts of the world, not so much. And so, so it is you want to have that counter cyclicality or lack of correlation completely between those markets. And again, the reason why people need to be here or in any market that they're looking at is you need to understand that. Okay, so what's driving that in India? It's not that you've got this massive thrust of global institutional capital in India's public markets. It's driven by retail domestic investors, which is new.
Right.
But understanding that gives you a different perspective and realizing, okay, the incentives of these investors is going to be different than a corporate pension plan. It's going to be very different from an endowment. It's going to be very different from other institutional investors and why they might enter a market and how they will behave. So that in and of itself is a diversifying characteristic.
Right. And Kevin, when you look at India, are there certain themes or sectors that have caught your interest more than others?
Yes, I mean, certainly technology focus is significant. Consumer has been huge. The whole thesis, which is proving out of the rise of the middle class. And what does that mean? Well, okay, so now you've got brands really developing and quick commerce, which quick commerce is fairly unique to India. It just doesn't work anywhere else in the world for a number of reasons. But so we're really trying to drive those unique opportunities. And I think, consumer is going to continue to grow. And it goes back to my expanding pie analogy. You've got the consumerism really growing. You've got brand recognition. You've got new product. So you think about insurance, health insurance. It's fairly recent here, right?
Right.
And so, especially if you get into the tier 2, tier 3 cities, and yet you have these companies being created that are addressing this.
And it's still single-digit penetration. Yeah.
And it's single-digit penetration.
Yeah.
And so you can take that example to a number of different areas, and say, you know what, this is going to continue. Now, at some point, you reach that inflection point where it matures and it stabilizes, and okay, now you're a mature market, and that Now you're going to pick your spots. But for right now, it's pretty broad.
Right. And Kevin, wanted to ask you your perspective on how you look at the liquidity of the Indian capital markets, right? Is that one of the key pillars for your underwriting a market? Like you need to have the capital markets to be functioning?
Short answer is yes. And India's market has been fantastic. The largest number of IPOs of any market in the world last year, I believe over 300. And the NSE had the largest value IPO, close to $20 billion of total IPO activity just on the NSE.
Yeah.
Which is bigger than any other market for 2024. That seems to be continuing this year. So yes, you need that. One thing that is lacking here still, but hopefully we'll start to see some signs, is M&A activity. And so strategic activity. Starting to see more sponsor to sponsor type activity. But really the IPO market is the driver right now.
Right.
So the fact that you have this underpinning of the retail investor, and just to enumerate on the significance of that, like I said before, it used to be you could map the Indian public market by foreign flows. Well, foreign flows over the last couple of years, tying a lot of things together here, because of the expensiveness, if you will, of the Indian market, have been outflowing. And you wouldn't know that though, because there's been stability. And the reason there's been stability is because the rise of the domestic investor has offset, those flows have offset the foreign outflows. So again, you've got a stability of market that is incredibly important here. So it's, there's a lot of good things to say, but yes, M&A activity is not there. And I'm sure it will come. But as of today, if you're thinking about how am I going to get liquidity, it's really the IPO market.
Right. So Kevin, I have to switch topics to AI. I would love to get a sense of, are you using AI in your daily workflow? Is the investment office using AI at an enterprise level? I would be very curious to understand.
Where I've seen it from an LP perspective, used a little bit more interestingly, and it's, again, this was a single isolated example. They were so curious about what AI could possibly do to help enhance their investment process that they actually developed their own model, put it to work, just let it fly as far as markets were concerned, tweaked it as they saw biases, saw things that came back, and eventually brought it to a point where they say, you know what, we're confident enough in this tool and to make investment decisions that we're going to take a very small sliver and let our AI tool invest. And, it'll be different. And they had the back data from, all the work they had done before, as they built this model of knowing that this is going to be a differentiated investment from everything else they were doing in the portfolio. Small enough where, hey, you know what, if at the very least, we'll get some great learnings about what this can do and how it actually works. But to me, it's incredibly innovative. I think they've gone about it in a very smart way. But by making it real, they're forcing themselves to pay attention to it as well. So I think that's pretty cool.
Very interesting. Kevin, you straddle so many geographies, so many asset classes. How do you keep up with what's happening in the world?
I talk to you. No, it's starts with, where am I getting my information from? So you mentioned home bias. Well, okay, if I only read the Wall Street Journal, I'm going to hear about the U.S. and I'm not going to get as much info as I might want to get about the way things work in other parts of the world. So when I first started coming to India, one of the first things I did was got a subscription to the Economic Times. And it's not that I'm going to get any huge insights, but it gives me a perspective from another part of the world, from that market that I'm trying to learn more about, and hopefully just makes me more knowledgeable as I delve into this market and think about it. So things like that. And of course, there's all kinds of this basic, headline feeds. I get an AI feed, which, and I get a legal feed. There's all kinds of things that you just get these little snippets of data that just help keep you attuned to what's happening in the world and what's happening in markets and technologies.
Interesting. And are there any favorite books or podcasts that you subscribe to and you would recommend?
So you're going to love this. 2 books that I would recommend. I'm a big believer in history. And so one of them happened to be written by a UConn professor. It's not why I'm plugging it, but it's called End Times.
End Times.
End Times. And it explores the cyclicality of essentially social violence, social unrest. And you think about, geopolitics. Well, what could really harm any market? If I have significant social unrest, that's going to really harm that market.
Right.
Until that whatever situation is resolved. So he's making the case in the book that, hey, this is something that happens roughly every 50 years, where there is some set of circumstances that drive social unrest. And the commonality is typically income inequality has been stretched to the point where folks who perhaps inherited their wealth are no longer able to keep up with the folks who are really driving the high ends of income production. And they become, if you will, disenfranchised and start driving the idea that, hey, this isn't working for me anymore. And so they're okay with social unrest and they actually can help foment it. And so, it's like, okay, well, that's scary. But also you take a step back from that and you say, well, could that happen? And where could that happen? And should I be concerned about this in any market I'm invested in?
So are you concerned today?
Am I concerned today? Yeah, I am, to be honest. No, there's a lot of reasons why things won't happen, why bad things won't happen. But am I concerned? Yes. So you could say, well, hopefully our investments climb a wall of worry and life is great. But yeah, it's just something I think for myself, I want to be mindful of, kind of be mindful of your surroundings, right? So that's one. The one I would really recommend, Daniel Kahneman, Thinking Fast and Slow.
Right.
And so what's that tell you? We were talking about biases before. It's all about biases and all about, but also about how your mind actually works and, what it is that flips on in certain situations. And the better situation is when the slow part, the really thoughtful part, is engaged. And so it's, behavior, which ties into behavioral economics and ties into all kinds of things that are really fundamentally important to the work we're in. But how many people get into the way the mind works and behavioral economics when it comes to investing? But no, because it does all boil down to biases as well, and being aware of those biases. I think that's instrumental. So
right,
I'd throw those 2 out there.
Right.
One scary, one hopefully revealing.
Great. And on that note, I would love to thank you for your time, Kevin. It's been wonderful to get your thoughts.
Yeah.
And we would love to welcome you to India on your annual trips.
Excellent. Well, it's always a pleasure. And thank you, Ganesh, for the opportunity. And I look forward to seeing you on my next number of trips.
Great. Thank you, Kevin.
Thank you.